All right, Tools of Monetary Policy. This is from Chapter 14, Section 4 from our textbook. We're going to talk about the Federal Reserve, or what's sometimes just called the Fed. And what the Federal Reserve does, what the Fed does, is three things. It has three big jobs. The Federal Reserve oversees the banking system. The Federal Reserve controls our monetary policy. And the Federal Reserve provides information to Congress and the public. Now, it's important to remember that people in the Federal Reserve are not elected. They are appointed by the President and approved by the Senate, but they are not elected by the general people. We will talk mostly about the Federal Reserve's role in controlling monetary policy. We've already talked about fiscal policy, but what monetary policy is decisions made by our central bank, by the Federal Reserve, about the amount of money in circulation and interest rates. The two are directly related. The amount of money in circulation is directly related to interest rates. And monetary policy has to do with the decisions made by the Federal Reserve, our central bank, about the amount of money in circulation and interest rates. The Federal Reserve is run by what's called the Board of Governors, and there are 7 members on the Board of Governors. Now, there can only be one member from each district, and our nation is divided up into 12 different districts. And each person serves one 14-year term. And as I said earlier, they are appointed by the President and then confirmed or approved by the Senate. Here are the different districts of our nation. And there can only be one person from each district at any one time. As I said, there are 7 members. And there is one chair for the Board of Governors, a person in charge, and currently that is Janet Yellen. She was recently appointed chair of the Board of Governors of the Federal Reserve earlier this year. She will serve a 4-year term, and she kind of serves as the spokesperson for the Federal Reserve. We also have the Federal Open Market Committee. This is all the board members plus 4 of the 12 bank presidents in each of the regions. And the New York Federal Reserve Bank president is always included because that is the economic center of our country. The New York Federal Reserve Bank president always has a seat on this open market committee. What the Federal Open Market Committee does is very important. They analyze those economic indicators that we've already talked about. Inflation, GDP growth rate, unemployment. And they are the ones, the Federal Open Market Committee, they are the ones who determine changes in monetary policy. And the decisions that the Federal Reserve make have everything to do with creating and destroying, and I'm using air quotes, destroying money. We're not talking about printing money. We're not talking about literally burning a dollar bill. What we are talking about is what banks do. And when banks give out a loan, they actually create money. When banks keep money in reserve, they don't give it out. They keep it in the vault. They're actually destroying money. And to get a better idea of this, you can look in your book, Chapter 14, Section... On page 284 and 285 in Chapter 14, there is a very good diagram that shows how banks actually create money. The Federal Reserve uses 2 main types of monetary policy. The first one we'll talk about is called easy money policy. This is sometimes called expansionary policy. And the goal here is to prevent a recession. We don't want the economy taking a downward turn. We don't want to see unemployment numbers rise. We don't want to see GDP growth rate slow down. So, to prevent a recession, the Fed is going to speed up the growth of the money supply. And here's how they do that. They need to increase the flow of money into the economy. What they need to do is get interest rates to drop. And what that does is cause borrowing to become cheaper or easier. Now, consumers are more likely to spend more. And when consumers are spending more because borrowing is easier, demand increases. When demand increases, production increases. When production increases, we see a decrease in unemployment, and we can hopefully avoid a recession. The other type of monetary policy the Federal Reserve uses is called tight money policy. Sometimes this is called contractionary policy. The goal here is to avoid rising prices. Avoid that wage price spiral we learned about when we read about inflation in the last chapter. If the economy is growing too quickly, we may need to be concerned about inflation. So the way the Federal Reserve fights inflation is to slow the growth of the money supply. And here's how they do that. The Federal Reserve does things that causes interest rates to rise. And as a result, consumers borrow and spend less. That's going to cause demand to decrease, like we see on the graph here. And when demand decreases, we see inflation rates start to drop. The first tool that the Federal Reserve uses to control the monetary policy is called open market operations. And this is all about buying and selling government bonds. Open market operations is a fancy way of saying buying and selling government bonds. First, the Federal Open Market Committee decides whether to use an easy or tight money policy. And if they want to use an easy policy, meaning they want to encourage economic growth, what the Federal Reserve is going to do is buy government bonds from individual banks. And now the banks give the Federal Reserve their bonds, and the Federal Reserve gives the banks cash. That means that the banks have more money to loan. So that they can loan out all that money that they have, the banks are going to drop their interest rates. When those interest rates go down, consumers like you and me are going to borrow more and spend more. And that increase in spending is going to lead to an increase in demand and all the positives that come with that we've talked about. If the Federal Reserve wants to use a tight money policy, If the Federal Reserve wants to use a tight money policy, in other words, they want to prevent inflation, what they're going to do is sell government bonds to banks. Now, those banks are going to use cash to buy bonds from the Federal Reserve. That means that those banks will have less money to loan. And since they have less money to loan, they need to make more of a profit on each loan. And as a result, they're going to raise their interest rates. Interest rates go up, and consumers like you and me are going to borrow less, and our spending is going to decrease. We're going to see demand decrease, and inflation rates will drop. That's open market operations, buying and selling government bonds. Another tool that the Federal Reserve can use is known as the reserve requirement. This is actually the least commonly used tool of the Federal Reserve. The Federal Reserve can take the required amount of money that banks have to keep in their vault. Banks have to keep a certain percentage of all deposits in their vault. Well, the Federal Reserve can change this. If they want banks to loan out more money, they can lower the reserve requirement. That will cause banks to lower their interest rates, give out more loans, and spending and demand will increase and hopefully bring down unemployment and encourage growth of our GDP. But If the Federal Reserve is worried about there being too much money in circulation, they're worried about inflation, they want to use a tight money policy, they could raise the required reserve ratio. That means banks now have less money to loan. And as a result, they're going to raise their interest rates, and buying and spending and borrowing will decrease, and inflation rates will hopefully drop. Part of the reason the Fed doesn't use this tool very often is because if they raise the required reserve ratio, banks may have to scramble to find enough cash to meet the new required reserve ratio. One of the more common tools that the Fed uses is known as the discount rate. And this has everything to do with the fact that banks always need to borrow money. Banks are always giving out too many loans. Banks are always having unexpectedly large withdrawals. So the bank can borrow money from the Federal Reserve. The Federal Reserve is kind of like a bank for banks in many ways. One way is that banks like Key Bank and Chase Bank can borrow money from the Federal Reserve. The discount rate, what we're talking about here, is the interest rate that banks have to pay the Fed on these loans. If the Federal Reserve wants to use a easy money policy and encourage economic growth, they can lower the discount rate. That will make banks more willing to go over and make them more willing to give out more loans. If the Federal Reserve wants to use a tight money policy, they could raise the discount rate. This will make banks less likely to go over and less likely to seek a loan from the Federal Reserve. The last thing we should talk about is the federal funds rate. And the federal funds rate is not a monetary tool. One thing we need to remember is that banks actually only borrow from the Fed as a last resort. Most of the time, they borrow from other banks. The federal funds rate is the interest that banks charge other banks. Now, this is not technically a monetary tool, as we just said, because the Federal Reserve cannot directly control this. This is determined by the other banks. This is determined by the private banks. The Fed cannot control the federal funds rate, but the Federal Reserve sets a target for the federal funds rate. And then they use open market operations like buying and selling government bonds to get the federal funds rate where they think it should be. And why this is important to you and me is that the federal funds rate influences the interest that consumers like you or I pay on our loans.